Federal Reserve Rate Setting Committee started the year holding interest rates steady. The S&P 500 and Nasdaq Composite had pulled back slightly ahead of the decision, and we saw the sell-off slightly deepening further after the announcement. This episode looks at the main takeaways and especially how Jerome Powell is navigating the call from the new administration to lower interest rates immediately. Hello, this is Bode Oshosami on Global Business Insights, where we bring ideas and discussions on the business headlines. According to the CME FedWatch tool, there was little or no chance of a rate cut at this meeting, while the tool saw 33% probability of a 25 basis points reduction in March. The focus for today's meeting is really on the slant of the language and comments from Chairman Jerome Powell, who, as expected, avoided guesses related to yet to be announced specifics on the new administration's economic thrust, but said he had not yet had any interactions with the new president. The statement that was released said the economic outlook is uncertain and the committee is attentive to the risks to both sides of its dual mandate, also sounding much less confident on progress on inflation. It was an unanimous decision. Here is a clip of Jerome Powell speaking at the presser after the FOMC meeting.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated this demand to you?
I've had no contact.
Thank you.
Thanks.
The main takeaways from my perspective: first, the Fed seems to be buying time with full optionality for the March meeting, allowing maximum maneuvering space depending on the data and the policy of the incoming administration. Second, the statement reads less confident in terms of progress on inflation. Many see a stickiness with risks tilted to take inflation higher depending on how and when tax rate deductions and trade tariffs are implemented. But the Fed did not see the labor market as a source of inflationary pressures. Then it is also looking more like a prolonged pause. You could call it a slightly hawkish slant rather than a short pause, but everything seems to be well laced with high uncertainty, still elevated inflation, solid labor market, plus an economy hardly in need of rescuing. Markets were unmoved. Nothing surprising in the statement. We saw equities marginally selling off. Bond yields slightly higher. Finally, in summary, it's about the data, which can be hard to predict, and also about new policy thrusts. What is unusual for the Fed is two dimensions of uncertainty to juggle, complicating today's decision and compelling them to simply wait for better clarity. Markets still roiled by Deepseek disruption are looking to the earnings releases of big tech firms. After an attempt to recover, we saw Nvidia's shares falling again today as investors are still coming to terms with implications of the disruptive capabilities of China's Deepseek. The US technology sector is still under pressure as analysts look beyond the Fed decision and paying more attention to the earnings releases and conference calls of three of the magnificent seven technology companies: Meta platform, Microsoft, and Tesla, and that will be out after the closing bell. Nvidia shares down about 4.7 to 4.7% most of the day. We'll see how it closes. We will replay our earlier chat on some of the background to this disruption that is still playing out in the global technology sector. Nvidia responded saying Deepseek is an excellent artificial intelligence advancement showing how new models can be created by leveraging widely available models and at a far lower cost. Analysts are hailing Deepseek as the disruption that is disrupting the disruptor and hoping that more startups like Deepseek emerge so large language models become more mass market and cheaper to deliver. Others are scrutinizing some of the claims. The claim that Deepseek spent only $6 million to do what Nvidia did for billions is simply seen as far from accurate. While we know Deepseek has found a way to innovate by leveraging proven technologies, the self-reported claim of a $6 million training cost is suspected as highly unlikely. Also last week, China said it would provide $137 billion in financial support for AI over the next few years. Deepseek founder Liang Wang also reportedly told Chinese Premier Li Qiang that American export restrictions on AI graphic processing units, GPUs, remained a bottleneck. Some analysts are forecasting an imminent shift from hardware to software, with Salesforce software player Microsoft and Oracle likely to emerge as winners. But there are lessons. First, the global markets are evidently very jittery. Too much hype has potentially distorted valuations, and the potential downside risk is there, calling for diversification of your portfolio appropriately. But it may also be a good time to buy the Nvidia dip for portfolios that are looking for an ideal time to get in the AI play. Most importantly, while the edge that Nvidia has will not be easy to erode, it will be eroded eventually, and we could see many black swans coming up. Still on AI, Chevron and GE Vernova have formed a partnership to develop natural gas-fired power plants next to data centers, aiming to tap into artificial intelligence surging demand for electricity. And there is more. Both Microsoft and OpenAI are probing if data output from their technology was obtained in an unauthorized manner, directly or indirectly, by Deepseek. All this as the US Navy yesterday banned members from using Deepseek in any capacity on potential security and ethical grounds. Just out, Microsoft beat Wall Street estimates for quarterly growth thanks to steady growth at its cloud computing unit, benefiting from substantial investments in AI capabilities. Revenue was up 12% to $69.6 billion in the quarter ended December, compared with forecast of about $68.78 billion. In extended trading, Microsoft shares were still negative, but was paring down some of the losses. We'll see what happens when markets fully open tomorrow. Tesla shares fell about 4% in extended trading after it reported earnings and revenue for the fourth quarter that was lower than expected. Earnings per share was 73 cents, below 76 cents expected. Well, that's it on this special late evening episode of Global Business Insights. We again remind you that you can watch us from next week on Business Day TV YouTube channel. That's Monday to Friday at 11 a.m. West Africa time. Thanks for watching. This is Bode Shosami.